All right. All right. Recording in progress. Beautiful. Now, what else would I do? I want to change my speak to my headphones. And this will be all right. Okay. Perfect. Now, again, volume good, audio's good because the chat is turned off. So I'm not going to be able to know. The volume is good, right? Audio is good. No thumbs up. One thumbs up. Two. Okay, good, good, good. Perfect, perfect, perfect. All right, so we got almost a minute and a half left. And as that comes down to a close, we shall continue moving forward. Okay, looks like we have almost a full house over here. Very nice. 173. Beautiful. Okay, so welcome everyone to a Forex orientation webinar. The reason why we have named it the orientation webinar on Forex because this is where we're going to go from the very basics of what is Forex, why we hear about Forex, why we want to do Forex, what's the first thing that comes to our mind, all the way to a point where you're going to be able to confidently execute a trade. So this is what I'm going to do, right? It's participant can chat with, there we go. All right, the chat is on. It feels kind of weird to have the chat off because I'm like, much more comfortable in answering some things on the go, but also sometimes, light roasting here and there. So it felt a little bit weird that there's no one talking on the side. So we're gonna keep the chat on. It keeps me more like, participated. All right, so let's move on with this. Okay, so whenever we start trading, what's the first thing that comes to your mind? I remember when I first started trading, the first thing that came to my mind, or the first thing that I really look into now, that what I heard was that Forex is something that's open all the time, 24 hours a day, no, actually 23 hours a day, and 5 days a week. And there was another thing that someone told me that, okay, like, Forex is a $5.2 trillion market. This means, man, like if you don't have any money, this is a $5.2 trillion market, and in this market it means you can make money all the time. Let me just turn off these annotations over here, disable annotations. Okay, so for all the guys over here, what was something else that comes to your mind when you hear the word Forex, or someone who, like, really told you this idea about making money from the markets? What's that one thing that comes to your mind? Scam. Okay. Get rich quick. Yeah, that's true. Get rich quick. But also at the same time, if it's too good to be true, it really is too good to be true. Gambling, that's correct. Like a lot of us, when we start trading, we start to look at trading as, like, a form of gambling. Like in the beginning, we're all very, very disciplined, but as time goes by, our gambling instincts start to come in. Let's take a look at this. So the first thing that comes to my mind is $5.2 trillion market, right? The next thing is that it's way bigger than the stock market. So the one thing about the Forex market is that it does not move comparatively as close to how the stock market moves. Like in the stock market, you can have, like, a 10% gain, or like a 15% gain, or like, stuff like that, 5% gain or a loss, like when it compares to like stocks and stuff like that. But in trading, when you're talking about Forex, like gold, pound USD, like in all the pairs, commodities, metals, they don't move as much as the stock market. Like you may see a movement of, like, 0.5%, maybe never 1%, but like 0.5%, 0.2%, 0.08%, which is why we have leverage, because the movement is not that much, right? It's a very small movement, which is why we have leverage in Forex to trade. The one thing is we learned about is patience, consistency, intuition, and discipline. That's correct. Again, it's open for 24 hours a day, 5 days a week. You can make money at any time of the day. This is something that really screwed me over, because when someone said, "Hey, like, you know what, man, you can make money at any time of the day." Now, I my first introduction to Forex was through a MLM company called iMarkets Live. That was my first introduction. It was IML, and then there was another one back in the day in 2016 to 2015 called Wealth Generators, right? So just from the name, Wealth Generators, it should ring some alarm bells, right? Generating wealth, like what the hell's that? Wealth Generators. And they told me that you can make money at any time of the day, right? But once you get a little bit mature in the markets, you start to look at, the sessions, the currency pairs, you start to understand volume, you start to understand, like, at what time of the day there's going to be movement in price, which you can actually trade. You start to understand that you can't really make money at any time of the day in the Forex market, right? Because when there's no more volume, what are you going to do? When there's news, what are you going to do? When the market is closed, or like, when we have a rollover time and the spreads are higher, what are you going to do at that time? Right. So this is something that really drives people in, like, hey, you can make money at any time of the day while you're working, while you're at the grocery store, stuff like that. Market sessions, different times to trade based on your availability, right? So this goes on to say that there are some concepts out there that say, hey, like, you know what? There are a lot of market sessions. We have the Asian session, we have the London session, New York session, and you can trade all these sessions to make money, right? But the reality is that when I first started trading, I was trading 2 hours before my work. Then I would go to my office. Like, we had an office. I would go there. Then I would trade at the office while we had our downtime. I would trade during grocery runs. I would trade during our gym time. I would trade during dinner, lunch. Like, I was always looking at the market. I was always looking at the charts, and I used to think that the more I'm going to look at the charts, the more profitability is going to increase for me. But it was the opposite, right? It was completely the opposite, because the more I looked at the charts, the more I took trades and the more I lost at the same time. Then after a little while, it dawned upon me that, hey, like, you know what? It's not about looking at the charts all the time. It's only about looking at the charts when the charts have your full attention. Just like when you go to the gym. So when you go to the gym, you go to the gym at the specific time and you only think about lifting weights, or you only think about doing cardio or the stairmaster or whatever the hell you're doing over there, right? You only think about that. So trading, it's exactly the same thing. Exactly the same thing. Like, so I was at a dinner yesterday. It was a family dinner, and there were a lot of guys there, and they were saying, "Hey, Raja, like, you're trading and this and that. So, like, what, like, how many hours a day do you trade, or how many hours a day you look at the charts?" Because I'm looking at the charts all the time. Like everyone's the same. So I'm like, I only look at the charts for about an hour and a half to 2 hours. That's it. Nothing more at all. Just 1.5 hour to 2 hours, and that's it. That's the only time I look at the charts, because you have to look at it this way, right? The time that you're going to dedicate to the charts, that time needs to be a time where you have nothing else to do. Like when you're completely free, you don't have to worry about family, kids, no job, no nothing. Like, that, okay, this section of my day, I have time to do whatever I want. So at this time, I'm going to look at the charts. And then you look at the charts and see that, okay, what session is present there? What pair should I look at? And all this stuff. So we're going to go over that too. Right. But it's very, very important to only look at the charts when it's convenient for you. It doesn't have to be the other way around. Whenever it's convenient for you, look at the charts. You dedicate when you're going to give your time to the market. Don't let the market dictate when you should be giving your time. Makes sense? Like a lot of times guys say, oh, like I haven't traded the whole day and now we have FOMC and I'm going to trade FOMC. No, you're not going to trade FOMC, because if the volume was not there when you were looking at the chart, what makes you think that now you're going to trade FOMC and make money? It doesn't work like that. And I used to make those mistakes all the time. I used to think that, okay, now there's volume in the market, which I don't trade, so I'm going to start to trade this. No, don't do that. Don't be a slave to the market. Let the market be a slave to you. It's just like you say, like, like when you, okay, so when you like a girl or a guy, like, and you're like, okay, you know what, I'm just going to play hard to get so that they get attracted to me more. It's kind of like the same concept. But anyway, to succeed, you need to create concrete, well-defined rules. So we're going to go over these rules here as well here today. So because more senior time than trade will be opposite of market analysis. Yeah, that's true. All right. Oh, what's going on over here? All right. Okay. So first, we're going to start with some very basic concepts. It's a warm-up. We're just going to do a very simple warm-up. And this warm-up is that what's the first thing that you look at when you're looking at the charts, right? So we're going to continue this webinar as if everyone is brand new, that everyone does not know anything about trading. So that's what we're going to do. First, we have the market sessions, right? The number one thing that you need to understand whenever you hear the word Forex is market sessions. One, we have the Asian session, right? We have the Asian session, we have the London session, we have the New York session. These are the three main sessions we have, right? So whatever time zone you're in, whether you're in the Eastern time zone, Pacific Standard time zone, London, Pakistan, Asia, Australia, whatever, you need to understand what sessions they are. Next, now we need to understand that, okay, we have the Asian session, London session, New York session, right? Every session has a pre-session. A pre-session means that what sort of volume is going to be there in the main session, right? That's the pre-session. When you do a warm-up, when you go to the gym, you do a warm-up, you're like, okay, I'm going to get ready to lift some weights today. You do some warm-up with like light weights and stuff like that. And like, sometimes it goes into cardio or sometimes it goes into weight training. So this is what the pre-session is. So whenever you look at banks, the way the banks work is, let's look at it this way. You have a bank. Before the bank opens at 8 a.m., employees still go to the bank, or like, when you're running a hedge funds normally facilitate order flow at like, 9 a.m., 10 a.m. Before that, someone's going to go in around 8 a.m., 7 a.m., 6 a.m., and they're going to see that, okay, what sort of order flow we had on the previous day to get ready for today, right? That's getting prepared for the full day. So that's when you have pre-Asian session. Sometimes there is volume in pre-Asian session. Sometimes there's no volume in pre-Asian session, right? So these are the times that I look at pre-Asian. If someone is trading the Asian session, this is what I look at. Pre-Asian session, 6 p.m. to 8 p.m. Eastern time. Let's talk about order flow. I don't know nothing about order flow. That's for all the SMC traders to worry about. All right. Next, we have the Asian Open. Right? Asian Open between 8 p.m. to 10 p.m. Now, the reason why I'm writing these times down is this is when there is volume in the market. Can you guys see my mouse? Is my mouse visible on the screen? Yeah? Okay, cool, perfect. Right? Next, we have the pre-London session. Now, I have made a lot of progress in pre-London session and London session. This has been amazing for me, pre-London and London. And most of the reason why, okay, so we're going to talk about the reason here later on, right? So first of all, I just want you guys to focus on the times when we have these sessions. Will Ted be on too? No, Ted's in Vancouver. Yeah. So next we have pre-New York, and after pre-New York, we have NY Open at 8 a.m. till London close. This is also a very high volume time right here. Requesting record. Brother, this meeting is being recorded. Yeah, it's being recorded. Right, okay. So the reason why I have these times on over here is for you to understand that these are the times when normally there's volume in the market. So when you have pre-Asian session, this is when there can be volume in the market between 6 p.m. and 8 p.m. If, for example, there's no volume at this time, there's a very high probability there's going to be volume between 8 p.m. to 10 p.m. in the Asian session. If you have the Asian session open from 8 p.m. till 8, 9, 10, 11, 12, 1, 2, 3, 4, till like 4 a.m., Eastern time, it doesn't mean there's going to be volume during all this time, right? We have 8 p.m. to 10 p.m. This is when there's going to be volume in the market. And usually I've seen like after 10 p.m., there's not much volume. When we're talking about pre-London, between 1 a.m. to 3 a.m., there's lots of volume. Same goes for London Open, same goes for pre-New York, London Close, NY Open, and NYC Open here as well. What's the intention of this webinar? Aren't all the Khan? Okay, so if you want to be removed, let me know. I'm going to remove you right now. This is why I have the chat closed, because retards come in and they ask these dumb questions. Like if you don't want to be in this webinar, you can just leave. Okay, so any question regarding sessions, only sessions so far. The important thing is to look at the time and see what time suits you best. For example, when I first started trading, this was back in Canada. I would wake up at around 5:30 a.m. I would leave for my office at about 8:30. So I start to look at that. Okay, what session fits best for me? So pre-New York fitted really amazingly well for me. 5:30 a.m. till 8 a.m. Eastern. There was volume at this time. We would trade this, and then I would go to my office, right? So that's what you got to look at. What time is going to suit you best? Recently, there's no volume in London session. Yeah, exactly, right? GJ has been running fine, but this is a volume shift. Sometimes you're going to see that there's going to be volume in pre-London, and then sometimes you're going to see that the volume from pre-London has shifted to London Open. Right. And sometimes what you're going to see is that, okay, there's no volume in pre-London, there's no volume in London session, and then you're going to see that there's a lot of volume during pre-New York. So these shifts in volume is something that you identify once you spend, let's say a couple months watching just one session. This is very important because a lot of guys, what they're going to do is they will focus on one session for a week, and then they'll say, oh man, Raja, like there's no volume in the session, and I'm going to change my session. No. You got to stick to that for a couple of months, and then what's going to happen is that you're going to really understand how the session works. It's a pleasure to reviewing the course. Also live with the summit will be clear. Thank you. What's the time in Dubai? Timing for London? What's the time in Dubai for timing for London session? I don't know, brother. Google that. How do you know if there's volume or not? We don't know if there's volume or not, and for us to know how there's going to be volume by looking at the candles, that's something that we're going to cover in this webinar today. Today, we're going to cover that. Okay, sessions is good, right? Let's move on. Next, we have currency pairs. This is really important. Okay, so I had a question yesterday from somebody, and this somebody has been in our in our group for about 2 years now. And his question was, hey man, I'm trading the London session. Which pair do you think is going to be the best for me to trade in London session? And now I'm like, brother, have you seen the webinars? You've been with us for about 2 years, and you're asking me the question, what pair you should be trading? So this is why these webinars are better. Okay, so what's this over here? False opportunities. Okay, so all irrelevant questions I'm just gonna ignore. 4-hour close. Yeah, I'm just gonna ignore all these irrelevant questions. If it's nothing to do with currency pairs, I'm not going to answer that. Time shifting has nothing to do with currency pairs. I'm going to ignore that question too. Okay, major currencies. When we say the word major currencies, what currencies come to mind? Major currencies. We have USD, right? USD, GU is not a currency, it's a currency pair. There's a big difference between pairs and currencies, okay? We have pound, USD, euro, we have AUD at times, right? So pairs now we have Euro USD, USD yen, pound USD, USD Swiss franc, USD CAD, AUD USD, NZD USD. Minor currencies, we have Euro GBP, Euro JPY, and blah, 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 onwards and so forth. Gold, I would also say, is one of the major metals to trade, right? It doesn't fall into currencies, but still metals. Now, the biggest difference between the major pairs and the minor pairs is that when you look at the charts, you will see that the major pairs will have a lower spread than the minor pairs, right? The major pairs would have a little bit of a lower spread than the minor pairs. And also another thing, if someone really looks at spreads and they say, oh man, like, you know what, my spread is too high. If you have a spread that's less than 2 pips, that's amazing spread. Great spread, right? And sometimes you may see that the minor pairs, they have a higher spread. What you will also notice is that minor pairs have bigger moves sometimes, right? So the spread is directly proportional to the move that you're going to have. Gold moves faster than currencies. Yeah, gold has a lot of volume. That's why. Okay. Now, we have these pairs. We also looked at sessions, right? We also looked at sessions. There's one thing I want to discuss, which I'm going to discuss after the slide, is going to be the speed of light, right? So if I don't remember, just remind me. Speed of light, and I'm going to discuss that one thing that I learned about yesterday, and I want to share with you guys. It's just a theory, but I don't know. So, how are currencies correlated in the Asian session? So let's say we have someone and they want to trade the Asian session, right? And now they say, okay, like, you know what, which pair should I choose? So let me try this over here. I have a pen. All right, perfect. So in the Asian session, we have which currencies are open in the Asian session? We have JPY. It's open in the Asian session. We have AUD, that's correct, Mr. William. AUD is open. We have NZD is open in the Asian session, right? So these three pairs, these three currencies, they're open, which means these three currencies have a lot of volume in the Asian session. So now, let me ask you this. If someone, so like, you know, any pair with this would work perfectly well. So let's say if you say, oh, you know what, I'm going to trade GBP, okay, let me do this. Let's say someone says I'm going to trade GBP JPY and I'm going to trade CHF JPY in the Asian session. That's a very good idea. And I'll say, okay, like, you know what? That's perfect. Go ahead, trade that, right? If someone says I'm going to trade ADUSD, NZDUSD in the Asian session, perfect, perfectly well. Because NZD is open and AUD is open, so there's going to be volume when you try to trade these sessions. And let's do this over here, right? Perfect. So in the Asian session, you have yen open, Australian dollar, New Zealand dollar, and gold also has a lot of volume in the Asian session. Now, there's also one thing. If you have traded the Asian session, you will notice that every pair that is correlated with the yen, for example, let's say you have euro yen. Okay, let's do this. Euro yen, pound yen, CHF yen, and let's say USD JPY, right? And I want you guys to really look at this, right? All the pairs that are paired with yen, you will see in the Asian session, they will all move the same. They will have very similar movements during that time. If pound yen is going to go up, this means Swiss yen is going to go up, euro yen is going to go up, USD yen is going to go up. All these pairs, they will have exactly the same movement when it comes towards your 15-minute candles, 30-minute candles, 1-hour candles, 4-hour candles, only during the Asian session, right? If you look at, let's say, AUD yen JPY, right? Sorry about my handwriting over here. AUD yen, or if you look at, you know, New Zealand, let's do this, New Zealand yen, whatever, these two will not have the same movements. Can someone tell me why? Can someone tell me why? This is a very, very important question. Actually, it's a very important concept to understand. Both are Asian pairs, that's correct, right? So the reason why UJ, EJ, GJ, Swiss JPY, they will have the same movements is because in these pairs, yen is the only currency that's moving the entire pair. Make sense? Yen is the only currency that's moving these entire pairs, and all these pairs, pound, Swiss, euro, USD, they're closed in the Asian session. So if a pair wants to go up, it's relying on the yen for it to move. If you look at, let's say, New Zealand JPY, right? For New Zealand JPY to go bullish, you will have to do analysis on the yen, and you're going to have to do analysis on New Zealand dollar, right? So if you want this pair to go bullish, then you'll say, okay, like, you know what? I need yen to be bearish, and I need New Zealand dollar to be strong so we can go up, right? That's a lot of that's doing a lot of analysis. So I don't look at that. The only pair that I'm going to look at is going to be a pair that's only being influenced by one currency, right? For example, pound yen in the Asian session, amazing. USD yen in the Asian session, amazing. Gold, super amazing. Love gold. Now that we're looking at the London session, in London session, you have pound open, euro open, Swiss franc open. Gold also has a lot of movement. Yen is also open during this time, but yen has no volume during this time. Yen has no volume at all during this time. So whenever you're choosing a pair in the London session, you're pairing the London session currencies with a currency that's closed at this time. For example, pound USD, right? Pound USD, where is it? Pound USD, perfect to trade in the London session. GJ, where's GJ? JPY, perfect to trade during the London session. Swiss yen, perfect to trade during the London session. Is New Zealand JPY perfect to trade during the London session? New Zealand JPY. Perfect to trade in the London session? No, it's not, because New Zealand is closed and yen is closed. There's no volume, right? If you look at AUD USD during the London session, no, it's not, because AUD has no volume and USD is closed. Same goes for USD JPY. You can't trade this in a London session. Same goes for, let's say, Euro GBP. Euro GBP is going to be difficult to trade in the London session because you have euro open and you have pound open. So when you have two currencies open at the same time, it's a little bit difficult, because now you have to do analysis on the euro, you have to do analysis on the pound. And I'm a very simple guy, like I like to see things very simple. I like to see very simple ideas, simple concepts, and then I go from there, right? So for me to trade in a London session is either it's going to be gold, or I'm going to look at, pound yen. That's all what I'm going to look at. It's not recommended to trade Asian pair like AUD JPY. No, you can trade it, but then you'll have to do analysis on AUD and JPY. So, what about GJ during New York? Have we went to New York yet? We haven't, right? We're still on London session. So just patience. What do you think about silver? Silver's good. I've never traded silver, so I can't say much about it. Yeah, I can only talk about the things that I have traded. Now we're at New York session. Now, when we're looking at New York session, now there are a lot of different things that are happening at this point. New York session has the most amount of volume out of all the sessions. The most amount of volume during the New York session. A lot of volume, right? Because you have New York Open and you have London Open at the same time. When we're looking at the New York session, now we have a lot of currencies that are open. We have a lot of opportunities. We have a lot of currencies open. When I first started trading, we were trading the New York session, pre-New York. And we were looking at, so we were in Canada, so we were looking at, the CAD right here, and we were looking at USD, right? So we're looking at USD CAD. And a lot of times when we're looking at USD CAD we noticed that USD CAD most of the time would range. And we're thinking, man, why is this thing ranging all the time? And then we realized that, okay, maybe this is ranging because the dollar is strong today and the Canadian dollar is also strong today, right? So we're like, okay, this makes sense. If in USD CAD, where's USD CAD? Right here, right? In USD CAD, if the dollar is strong and the CAD is strong, this means that the pair is going to range. We're like, okay, interesting. All right. So which other pair that we can look at in a New York session, which is only relying on one currency? So next one, we chose USD yen, right? In USD yen, this is magical because if the dollar is strong, then the whole pair would go down. If the dollar is weak, then the whole pair would go down. Oh, no, the first one go up and the second one go down, right? We're like, oh, perfect, right? So I guess we're just going to look at a pair that is influenced by only one currency. Awesome. This led us to trade like, pound yen, because in pound yen, like, pound is the only currency that's moving the entire pair. Same goes for gold. Start trading gold. I dabbled a little bit in Euro JPY. I also dabbled a little bit in Euro USD. And the reason I started trading Euro USD in New York session was because it had like the lowest spread, and I was pretty dumb at that time too. I've actually never won a trade on Euro USD. Never. I've never been able to win a trade on Euro USD. I hate this pair. No trade has ever been won by Raja Banks on Euro USD, whether it's on IC Markets, Vantage FX, whether it's on my broker, Dominion Markets. Never. I've never won a trade. Well, I haven't really traded USD on Dominion Markets, but yeah, I've never won a trade. Maybe because, I always try to trade this in a New York session when both pairs are open or whatever, but yeah, never. Your JPY has been good, right? So the most important thing to understand from this slide is which pair are you going to trade during the session that you're going to choose to trade. What do you think about US 30? US 30 has a lot of volume around NYSE Open. Around NYSE Open, US 30 has a lot of volume because, it really waits for that. Why is there a lot of volatility with gold, specifically just before pre-NY close? Pre-NY close because it's NY Open. EU, both pairs are influenced by the session during NY. Yes, that's correct. So any questions on currency pairs? Any questions on currency pairs? You're just taking a mental note on which pair you're going to focus on. That's it. That's all what you're doing at this point. Nice to have you back, old friend. Thank you, Christine. Nice to have you here. What currency pair has more volume during these sessions? I don't know. If you're trading the Asian session, pound yen is good, gold is good. London session, pound yen is good, gold is good. In New York session, pound yen is good, gold is good. Like those are the pairs I trade, right? So, what session is okay? How come gold is good in all sessions? Because gold is good in all sessions. Gold is directly proportional to Australian dollar, which is why gold has volume. Gold is also influenced a lot by the London session as a whole. That's why it has a lot of volume. Gold is influenced by, the overlap of London session and the change in the US dollar. So gold has a lot of volume. If you're trading only GJ, does it make sense to pick second pair also with GJ or something completely different? That's totally up to you. If I'm only trading pound yen, it depends on, let's say I'm trading pound yen in the New York session, then I'm also going to look at gold as well, So, yeah. Okay, so one thing I want to talk to you guys about, the speed of light. Is gold a safe haven? If you Google that, you'll get the answer. The answer is going to be yes. Speed of light. Now, I was reading this theory yesterday that how we are probably living in a simulation, right? There was also a theory that when you sleep, you actually die and you wake up in another parallel simulation with the same conditions that you have, right? And the biggest example we can give is through video games, right? So when you play a video game, let's say you play Call of Duty or whatever, right? You play Call of Duty, it's an open world, you can go wherever you want, but at the same time, you're limited. You are limited to that world. Skipping the cutscene, okay, yeah. Because we're limited to that world, right? Like we can go to the edge, but we can't go through that edge to see what's on the other part. And in the same way, we can't go faster than the speed of light. We're limited with the speed of light. We can't go faster than the speed of light. We can't go outside of our own galaxy to another galaxy. So if a video game is made by somebody, and if we can't go faster than the speed of light, which means we're limited at that speed, maybe we are also, this whole simulation is also created by somebody, right? I don't know. I think you're in Pakistan. Yes, I'm in Pakistan. All right, let's move on over here. Just a little bit of a break we had. So we're good with this one, right? We're good with this one. Currency pairs. Press F to respect. Um, yeah, I don't want to press F. I don't know what's going to happen. You said the market didn't move after London close, but gold sometimes moves faster London close because of what? Because of London close. What is the motive of that story? There's the motive. Don't you think Asian session is the safest to trade, not high volume? Yeah, but like, I like high volume. Take advantage of I take advantage of volume in the market to make my gains. That's what I do. All right, something very, very basic. How prices are measured. Prices change in price of a pair is measured in pips. We all know this, right? Pips, baby pips. When I first started trading, someone told me to go read baby pips, and I was like, okay, sir, I will go read baby pips. I read the entire baby pips. Right now, when someone comes to me and they're like, hey man, like I want to start to trade, what should I do? I tell them, you want to start trading? Go read baby pips, and they take that like they get they get kind of like mad at me. Why are you sending me to baby pips when you have your own whole course? And the reason why I say baby pips is because I say, man, baby pips built my foundation, so it can really build your foundation as well. And once you're ready with that foundation, then you can start to create on top of that foundation. Very, very important. You mean the Bay Pips course? Yes. And if 10 people come to me and I tell them go read Baby Pips, only one goes and really reads Baby Pips and comes back to me and says, hey, Raja, I've done the Baby Pips thing. And I'm like, wow. Like, so it just filters out all the guys who are going to waste my time down the road. Right. So 1 pip is equals to 10 micropips, which is also points. Like on MetaTrader, when you measure pips, it's going to show you in points. 10 pips is equal to 100 micropips, whatever. Now, if pound yen moves from 131.220 to 131.120, you're basically subtracting the price. And if you subtract the price, you're going to get points, which is 100 points. It is, let's say, 10 pips. We're good with that? Okay, so one question I want to ask is, who is brand new to this? Like completely brand new, who has never heard about pips? Don't be shy. Just say it. Tokidoki, Sadula, Michelle Escalante. Okay, awesome, right? So pips. We measure prices in pips, right? So any question you guys have, I've made a mental note of you guys. You can just ask, right? There's no stupid questions for you guys. Anyone who has not said me, there's always a stupid question for you guys. So what's this? Quantum physical explanation of Samotra that's saying every day. Okay, irrelevant right now. So pound yen, if pound yen, you look at the price and it moves 131.220 to 131.120, that means it has decreased in price. It has decreased by 100 points. So this means it has decreased by 10 pips. And we're also going to look at the charts here later on too. At the same time, if you look at Euro USD, and you see that the Euro USD change of price was from 1.08400 to this price, don't be overwhelmed by the numbers. All you got to do is take out your calculator. I don't have mine over here, but if you take out your calculator and you subtract these two prices, you'll get a number. This is always going to be in points, 250 points, right? And that's going to be 25 pips. Will you be making a webinar for experienced members? If you're experienced, you don't need a webinar. So that's a wrong question. If you're experienced, you don't need a webinar. We have a lot of webinars for you in the database. Don't worry. USDJPY, if it moves from 106.300 to 106.658, you subtract, you get points, 268 points, which is 26.8 pips. Trust me, you're never going to be doing these subtractions in the real market. It's always going to be done for you, right? So this is just a little bit of a theoretical concept to know how pips and points are basically calculated. Now, gold is a little bit different, right? Gold. Now, whenever you're looking at gold will always move in dollars, right? So if you look at the price of gold is now what? 1982, is it? Let me take a look right over here. 1982, 1981. I think that was 1981, right? 1981 is the price of gold right now. So whenever you're going to look at the chart, you're going to see that number 1980. This means that 1 ounce of gold is equals to $1,980. But over here, this is, let's say, worth like $1,715, 1 ounce of gold. Right now, when you have a gold move is always going to be in dollar, right? So if gold moves from 1715.50 to 1717.50, this means you have a $2 move, and this is equals to 20 pips. Like a lot of guys have these questions about how do you measure gold pips and this and that. So whenever you have a change of gold price, that's basically the amount of pips. So if, let's say, gold moves from 1715 to, let's say, 1720, now you have a $20 move on gold. No, 1715 to 20, you have a $5 move on gold, which is 50 pips. All right, what's this over here? What is a lot? Okay, we'll go over lots here as well. Bro, we love your webinar. Regardless of experience. Thank you, man. I appreciate it. Can we become profitable trader by account of 200? No. If you have a $200 account, you probably can become a profitable trader till like $1,000, but it's going to take a long time. I say if you really want to be okay, confident, and you want to start to make like money with trading, a really good amount is going to be, I'd say, maybe around like $5,000, 5,000, 2,000 to 5,000. Is there any simulation at the end? No, there's no simulation. I think next week we will have a simulation. All right. Lots and leverage. Now, first thing we've done is market sessions, right? We've done market sessions. We've done the times of market sessions. Second thing we've done is currency pairs, right? Currency pairs, which pair are you going to choose, right? We got the market session. Which session are you going to choose? We have the currency pairs. We talked a little bit about like, pips, how to calculate pips. Now we're going to move on towards lots and leverage, right? Lots and leverage is what you basically look at based on how much you're going to risk in the market, right? So leverage. Leverage gives you the ability to determine how much you can risk at any given time. Most brokers offer a leverage of 10 to 1, all the way up to 500 to 1, like 1 to 500. There are also brokers out there who will give you a leverage of 1 to 1,000, 1 to 5,000, which is absolutely insane. When I first started trading, I had like a $500 account, and I thought that the bigger the lot size, the better it is. The bigger the leverage, the better it is, and I quickly understood that the bigger leverage you have, the more you can risk at any given time, right? Which is obviously sometimes you can make money, but also at the same time, you can also lose that money as well. So I'd say like maybe a good leverage to use would be like around 1 to 100. 1 to 100 is a perfectly fine leverage. You're not risking a lot at the same time too, right? 500 to 1 it's a lot of risk. This means, let's say if you have $1,000 account, at any given time, you can lose like $900 or like $800 on 1 to 500 leverage, because in the beginning, when we start trading, we let the losses run, right? When we let the losses run and they keep on piling up and up and up, and it's also like, it's not a good outcome in the end. So when you're 1 to 100 leverage and you have $1,000 account, with 1 to 100 leverage in $1,000 account, you may be capped at, let's say, losing $500, right? I've seen a couple of students in the Slack group using supply demand in their analysis. Is this something you recommend to implement? So I think supply demand, support resistance, zones, they're all the same thing. Supply demand is mostly mostly this concept comes from like, stocks and stuff like that. So I think they're all the same thing. So my recommendation would be to stick to 1 to 100 leverage. Nothing more. Something less. It can be less if you want to, but I'm okay with 1 to 100. Lot sizes determine your actual risk and the amount of dollars you can potentially gain or lose. This is also very, very important. Now, when you look at your MetaTrader, and you will see different lot sizes that you can use. The number one is going to be 0.01, which is the smallest lot size you can use, right? If price of the market moves, let's say 15 pips, which also means 115 points, and you have 0.01 lots, you can make $1.5. Very simple, no problem. If you have 0.10 lots and it's the same change of 15 pips, you're going to make $15. With one lot, it's going to be $150. With 10 lots, it's going to be $1,500, right? But also what you're going to notice is, that if let's say you're trading gold, right? Now, hear me out. If you're trading gold, right? You're trading gold and there's a change of 15 pips in the price of gold, and you have is a $1 lot size, you're going to see $150 made. But if you're trading GJ, Sahil Khan, this is not with GJ. Guys, listen. So I'm going to say this one last time. Whenever a question pops up in your mind, right? Whenever a question pops up in your mind, if you guys have dogs, right? And if your dog wants to run, what do? You grab hold of the leash and you hold the leash tight. You don't let the guy go. You hold the leash tight. You're like, no. Don't run right now. We're going to stay on the leash and we're going to stay calm down. So a question is like a dog in your mind. So whenever a question comes to your mind, just hold on to that question. Hold on to the urge of typing that question and hitting send. And I can guarantee that in the next 5 minutes, that question will be answered. Okay? Just hold on to the question. So now with gold, you'll see obviously like the same thing, if it's a one lot traded and there's a 15 pip up or down, and you're going to see the result is going to be $150. But when you're looking at pound yen, for example, if you have a $1 lot and the price moves by 15 pips, you may see the gain would be around maybe like $130 or $120, because the pip values, right? Pip values are different for different currency pairs. It's very different. We also have a blog for that, and I'm gonna dominionmarkets.com, and let me give you guys the link to that blog so you guys can later on take a look at that. It's on pip values, and this is the link right here. I'm going to post this in the chat. Pip values. This will give you a complete breakdown on how, different pairs have different values on their pips. What leverage do you use? I said it like 3 times, 1 to 100. Okay. Any questions on lot sizes and pips? Any question on lot sizes and pips? No? Okay. Crystal clear. 1 to 100 leverage, what's top percentage risk allowed? Buddy, why are you even asking about what's the top risk to use? Just ask, okay, I'm going to use 1% risk or 2% risk. That's it. Top percent risk, you can use like 50%. Who cares? What's the perfect time increase of lot size? The perfect time you can increase the lot size is when you are comfortable. Trust me, that comes with time. That comes with time. Your confidence is going to dictate that now you're going to increase your lot size. It's just like, when you're riding a bike and your bike has those training wheels on, a time comes where you're like, okay, you know what? Let me remove these training wheels. That's like increasing risk. It's good to trade with $200 live account. Yes, it's good to trade with $200 live account. Once you will read off the market as how much percent do you risk per trade? I risk like 2%, 3%. Sometimes I risk 5%. If I'm really trying to make a gain on something that I've seen all the time, I try to risk like 10% as well sometimes, because with confidence, then you can do those sort of things. Okay. Risk management. Who has magic keys? For a 5,000 USD account, what do you recommend? I recommend 1 to 2% risk. And we're going to talk about that now. Guys, keep your questions to yourself for the next 5 minutes. Whoever has magic keys, this is the formula that we have used with magic keys. Dollar risk over stop loss in points. calculating lot size, right? How do you calculate your lot size? This is the formula that we use, right? Let's say, for example, you want to calculate your lot size, and you have and let's say you have a $1,000 account, right? You have a $1,000 account, and you want to risk, let's say $15. You want to risk $15. You look at the charts, and on the chart, your stop loss is going to be 15 pips, which is going to be 150 points. And now you're going to calculate your lot size, right? So zero, no. So 15 goes by 1, 15 this goes by 10. So this is 1 by 10. 1 by 10 is what? What's 1 over 10, guys? Mental mathematics. What is it? 0.1. Perfect. So your lot size is going to be 0.1. Right? That's how we calculate lot size, theoretically, lot size, right? So let's say, for example, you want to risk $20, right? And your stop loss is 200 points. So 0 goes by 0, 2 ones are 2, 2 tens are 20, same thing, 0.1, right? 0.1. 0.1. So that's how basically you calculate lot size. This is the formula we used in Magic Keys to calculate your lot size on the go, your risk on the go, and all those things. So risk management 1.0 is basically understanding what sort of a risk are you going to use. This is very important. This is what I use all the time. Are you going to use static risk, or are you going to use dynamic risk? Yes, points are different from pips. 1 pip equals to 10 points. That's basically what it is. 1 pip equals to 10 points. Right? So what are you going to use? Static risk or dynamic risk? Whenever you're trying to use risk. When you're using static risk, in static risk, your risk is always like, either you're going to use 1%, or you're going to use 2%, or you're going to use 3%. It's always static. It's always one position you're using all the time. When we're talking about dynamic risk, right? In dynamic risk, let's say, for example, you want to use 2%. In dynamic risk, you say, okay, you know what? Since I'm unsure about this certain trade, or since I'm unsure about the certain move, I want to cut down this 2% risk into multiple different positions. Or you're going to say, okay, you know what? I'm going to open one position with 1% and another one with 1%. I'm going to open 2 positions because I want to cut down my risk. Or you can say that, okay, you know what? I'm going to further drop this down into 0.5, right? 0.5% and 0.5% right over here as well, like into 4 positions that you're going to use right here, right? So that's what dynamic risk is. Dynamic risk is where you break down your full risk into multiple parts to further manage risk. Static risk, because sometimes market don't retest. That's true. What do you like the most, static risk or dynamic risk? Me personally, I like static risk better. And I'm going to explain to you why I like static risk better than dynamic risk. Dynamic risk, sometimes I'm going to use, but not all the time. Static risk, I'm going to use because static risk, it gives me the opportunity to manage my risk or close positions in half if price goes the opposite way. It allows me to do that. With dynamic risk, as you're entering, let's say, first position 0.5, you've already managed risk. Because if you're total going to risk 2% and you're entering the market with 0.5%, you've already managed risk at that time. And then once you see price goes in your favor, you add another 0.5. So we're going to talk about this here as well. If I'm beginner and currently learning, go with the 0.01. Thanks, Mo. Right? So any questions regarding static risk and dynamic risk? I already answered what I use. I use static risk. Better to use 1% from capital per profit or just 1% from initial capital? Toki doki. 1% from full capital that you have. Full. Like if you have $1,002, 1% of $1,002. Is layering part of dynamic risk? Yeah, we're going to talk about that too. Any question regarding static risk and dynamic risk? Like we're going to talk more about this too. Would you mind touching on when to increase lot size as account grows? Yes, we're going to talk about that too. So other than this, we're good? We're good with this? We should be good with this. All right. What percentage risk is, guys, are you trying to troll me? Like, what the fuck is this? What percentage of risk is good for a $2,000 account? Is like, are you trying to troll me, or is this like a real question, or what the fuck is going on? Didn't we just say 1 to 2%? What is this thing over here? I just don't understand. I just don't understand, man. Like, I don't get it. Does someone scoops out your brain every morning when you wake up, and then, man, like, I just don't get it. Wow, it's just unbelievable. Oh my God. Whew. Holy. Just wasting time because they don't focus on a webinar. Yeah, man. So crazy. So crazy. I just don't get it. Why are you even trading, man? Just stop trading. Teaching is hard, trading is even more harder. Okay, so we're gonna take like a 5 minute break over here. It's 1:54. So we're gonna come back at like 2 p.m. Go to like no, actually we're gonna take like a 2 minute break. I'm just gonna go do something which will take me 1 minute, and then we're gonna come back. Yeah. All right. We are back. We are back now. Awesome. Do this over here. Okay, so we're still recording. That's beautiful. I have a question. Okay, sure. What's the question? Does anyone here trade use 30 Dow Jones? Use the biggest thing, the biggest moves? Yeah. Around like NYC Open, it does have a lot of big moves. Do you prefer fixed lot over percentage based? Fixed lot over percentage based? Yeah, so we're gonna go over this as well. We're gonna go over this as well. Okay, time frames. Oh, some question about risk. Okay, let's say you got $10,000 account and you use 1%. Okay, let's say you lose 20 times and your account becomes 80,000. Oh, 8,000. If you use 1%, basically you will never lose your account, right? Oh, I have to retake this one. Mr. Bax. Okay, so the question was that if I lose 20 trades in a row, this means that you're never going to be able to get that back. Now, here's the thing. You will never lose 20 trades in a row, right? If you're going to lose 20 trades in a row, this means you have no risk management. You're not looking at your losses. You're not learning from your losses. You're not doing all of those things because whenever I lose a trade, when I lose a trade, I consider that as an insult to my intelligence, right? Because I myself, I can't lose a trade. If I lose a trade, that's something massive that's happened. Now, when I'm going to lose a trade, I'm going to look at the price, I'm going to look at the market structure, and I'm going to ask myself questions that, okay, Raja, why did you lose this trade? What was there something that you missed? What was there something that you didn't pay attention to? What happened? Because I'm really going to go anal on that one loss so that I make sure I don't take that same loss the next day. Because if I do take that same loss the next day, then I may not make the money that I wanted to make. Right? Because in this business, this is very, very serious. Like a lot of guys don't take it as serious as they should. Because whenever you lose a trade, this means you did not make the money you were supposed to make. It's very, very important. So whenever you lose a trade, you got to look at that trade and be really stringent on why you lost that trade. Very, very important. So when you come to the markets with that mindset, you will never lose 20 trades in a row. You get me? It's never, ever, ever going to happen. You're never going to lose 20 trades in a row if you come to trading with that same exact mindset. My win rate is like 55 to 60%. Yeah, exactly. So if you run a business and you lose a client, Rock, you're absolutely right. When you run a business, you lose a client, that is something massive. So losing a trade is exactly the same thing as losing a client, losing a sale, losing a deal. You got to take it very, very seriously. And a lot of guys don't take their losses seriously because you're over trading, you're over risking, you're not serious about this. You're just treating it as just like a whatever hobby. Like, when there are guys out there who are really seriously making some sick amount of money from the same thing that you don't take it seriously. Right? So you have to take it very, very seriously. Very seriously. Losing a trade or violating a rule, both. I get it. No, there's no such thing as a dumb question. Okay, time frames. Very important. Now, the first thing, we have the daily time frame. Now, this slide is very important, right? It's not just a slide of, you have the 4-hour time frames and the 1-hour time frame and a 30-minute time frame, blah, blah, blah. It's all good. This slide is not about that, right? This slide is much more about just time frames, and a lot of these gurus out there, they're not going to teach you this. And I'm going to be probably the first one to bring this idea to you guys. Now, let's say you're looking at the daily candle, right? Now, you guys may note this. No, you guys may know this subconsciously, but consciously, you may not know this. And I'm going to bring this to your attention. Let's say you have the daily candle. What's the first session that starts when you have the daily candle? You have the Asian session, right? Asian session starts at the daily candle. So this first 4-hour candle, what does this first 4-hour candle comprise of? The Asian session, right? Perfectly right. Now, we have the second 4-hour candle. And also, let me write down the times over here too, right? So this is like between 5 p.m. till 9 p.m., right? This first 4-hour candle. How about time changing these days? Irrelevant question. Right now, the second 4-hour candle, this starts from 9 p.m., goes all the way till 1 a.m. Right? This 4-hour candle, do you think this time between 9 p.m. and 1 a.m. has some volume? Yes or no? Have you seen a lot of volume? No, right? There's a very low volume. Yeah, Eastern Standard Time. Low volume. LV stands for low volume, not Louis Vuitton. Low volume, right? Now we have the third 4-hour candle. This 4-hour candle is from 1 a.m. Eastern till 5 a.m. Eastern. This 4-hour candle, you have, pre-London Open and you have London Open, lots of volume at this time. Lots of volume, 1 a.m. and 5 a.m. This 4-hour candle right over here, the third one, right? So does this make sense to you? Okay, probably not now, but very soon it's going to make sense to you, right? Now when we're looking at the fourth one is from 5 a.m. till 5, 6, 7, 8, 9, 9 a.m. This also have lots of volume. Why? Because we have the NY session in it, right? NY session. Fifth 4-hour candle is from 9 a.m. till 1 p.m. Eastern time. In the beginning, there's some volume because you have London close in the beginning, and the half of the 4-hour, the volume kind of dies along, right? And the last 4-hour candle basically has no volume at all. So just by looking at these 4-hour candles, right? Just by looking at these 4-hour candles, which 4-hour candles do you think is gonna be the best to trade? 3 and 4, okay. The third one, okay. 5 and 9, 5 and 9, okay. That's good. That's good. So the third and fourth one is going to be one of the best 4-hour candles to trade, right? So just as you're looking at this, can we agree that, oh yeah, the 1, 3, and 4, okay, fine. So you got the Asian session there as well, 1, 3, and 4. So if you're looking at this 1, 3, and 4 4-hour candles, can we agree that if you're looking to trade these times, all you're focusing on is to see where this specific 4-hour candle can go? That's it. You're not looking at 20 candles before, you're not looking at 50 candles before or 100 candles before. All you're concerned about is where this one specific 4-hour candle is going to go. That's it. Based on what you said earlier, this would also depend on the pair being traded. Yeah, exactly, right? But we're not going to get into those complexities. We're just looking at the most basic thing over here, that where do you think that the next 4-hour candle can go? Now, let's take a look at this next one. Right now, we got the 1-hour candles right over here, right? We got the 1-hour candles, right? So now when we're looking at this, some more information, when we're looking at, let's say, the fifth 4-hour candle, right? So this is between what? 9 and 1, 9, 10, 11, 12, right? So 9 a.m., lots of volume. 10 a.m., lots of volume. 11 a.m. volume starts to die down, and then 12 p.m. volume just dies. Got playback. What does that mean? Right? So this makes a lot of sense. So if you're looking at the third 4-hour candle, you can look at this, right? 1 a.m. Eastern, pre-London time. 2 a.m. Eastern, London time. 3 a.m. Eastern, London, open, right? And then 4 a.m. Lots of volume during this time. Now, when we're looking at the 1, 2, 3, 4, fourth 4-hour candle, right? This is 5 a.m. Eastern, okay volume. 6 a.m. Eastern, volume starts to come in. 7 a.m. pre-New York, volume. 8 a.m. NY open, lots of volume. Does this make sense? Time frames? Do these time frames make sense now? Right? So if you're looking to see where this, let me change this stupid color over here. Ink color, this one. Okay, so let's say if you're looking at this 4-hour candle and you're looking to see where this 4-hour candle is going to go, what are you looking at? You're looking at the 1-hour market structure. That's it. That's all what you're looking at. You're looking at how the 1-hour candles are forming, and then you're looking at how the 30-minute candles are forming to anticipate where the full 4-hour candle is going to go. Do you trade 6 a.m. to 9 a.m.? Yeah, sometimes. So rich in information. Thank you. Regarding the SRC, your direction is where the 4-hour candle can go. Yes. This may be irrelevant. Okay. Please, can you attend to this? Why 4-hour candle close is different on Dominion Market compared to TradingView? The reason why is because we use a different liquidity provider. So our liquidity provider goes off of London close, which is why there's a 2-hour difference in the 4-hour candle. But still, it's all the same thing right here. So if you're thinking where that section is going to go, that 4-hour section, you're looking at the market structure on a 30-minute, 1 hour, right? So whenever I'm looking at the charts, I'm looking at, okay, if I'm going to be focused on this time stat right here between 1 and 5, then I'm looking to see that, okay, all I got to focus on is on this. I don't give a shit what this did. I don't care what this did. All I focus on this right here. That's it. That's all what I focus on. That's it. According to our webinar, can trade on daily time frame? Yes, you can trade on the daily time frame. You can. So, any questions on this time frames section? Right? I told you this is way more than just 4-hour, 1 hour, 30 minutes, way more than this. And you all know this too, but it wasn't presently available, this information. So you got to really dig deep in your mind and extract this information, be like, it makes sense now. 15-minute time frame, no. A 9 to 1 4-hour candle close is huge consideration. Yes. Most of the time you focus on 30-minute, 15-minute. Yes, I do. Market structure, and I also focus on the 1-hour market structure. I focus on all the time frames: 4-hour, 1 hour, 30-minute, 15-minute. How can you take your daily bias on previous daily or 4-hour? You can by looking at the chart. That's a irrelevant question regarding to the time frames right here. That's more of a technical analysis question. So entries and TPs on 4-hour? No, we're going to talk about entries and TPs. We're looking forward to some examples. All the examples are in the charts. Yeah, but we're going to do some examples too. Okay, so we're good with this. Awesome. Let's do this one. If we busy at that session, can we trade another time frame and come back to the same session? No. We just talked about this in the beginning. You can't do that. How important the 4-hour candle close is very important. So the close of the 2 4-hour is only important to anticipate direction of the third one. Yes, that's correct. To anticipate the direction of the third one. If the 2 4-hour is creating a support, and then you're looking at the lower time frames and they're also creating a support, then that means there's a high probability for price to continue pushing, in your desired direction, basically. Okay. Nope. Let's do this. There we go. Starting to get cold over here. I'm going to turn on my heater. What if the 2 4-hour is not creating a support? Well, now I'm not going to go into what if scenarios. There are infinite amount of what if scenarios. What's the actual reason of 15-minute weak confirmation? Because it's just weak confirmation. 15-minute is a weak confirmation. And let me give you a good example on that, right? Let's say you have some siblings, right? And let's say you're the youngest of your siblings and you want to go out to play in the park. Who are you going to ask? Are you going to ask your older brother, or are you going to ask your mom or your dad? You're probably going to ask your mom or your dad, right? Because if they say yes, that's a good, strong confirmation. If you ask your older brother and if he says yes, then that's a weak confirmation because your mom and dad may say, hey, what made you think you can ask him, you know? So the other 15 minutes is a weak confirmation. All right. So we're good with time frames. Candlesticks. Who knows about candlesticks? There's always something to learn from basic concepts. But let's talk about candlesticks right here. Candlesticks. There are only two types of candlesticks. This is what I understood so far. 4-hour close huge factor is the mean for structure. That's correct. And we're going to talk more about structure as well. Right. So there are two types of candlesticks. You have the bullish candlestick and you have the bearish candlestick. Very important, very simple, straightforward, right? This is an example of a bullish candlestick. A bullish candlestick opens at the bottom, it goes up in price, and then it closes at the top, right? And as the candles form, the candles also have a top wick, and the candles also have a bottom wick, right? So this means that during the time this candle was open, right? During the time this candle was open, it moved down to create a low and it also moved up to create a high. But as so let's say this is a 1 hour candlestick, right? And this candlestick opened at 2 p.m. and it closed at 3 p.m. Maybe at around 2:40, the candle made a low right over here. At around, let's say like 2:20, the candle made a high over here, but it closed right here at 3 p.m. So that's how you form this candlestick. Yeah, so the reason why 15 minutes is a weak confirmation, Mo, you're absolutely correct that the 15-minute candles are much likely to break the highs and the lows. There's a very, very high probability, and that may throw you off your analysis. That's why 15-minute is a weak confirmation. Right? Okay. So when you have a bullish candle which has a wick to the top, that's basically a range which is